Good morning, ladies and gentlemen. I'll just take a couple of minutes to give you an introduction to what we're doing today, right? This is the 2023 AFEX Annual Commodities Outlook. Once again, I appreciate everybody that took time out of their busy schedule to join us on this event. I have a small opening speech prepared, so I'll just quickly go through it to set the pace for what we'll be doing today. Over the past couple of years, agriculture has increasingly captured the attention of stakeholders in the country, partly because of its significant contribution to our country's GDP, which is estimated about 26%, and very, very significant. When you have a sector contributing a quarter to your GDP, then you take that sector seriously. But on the other part of it is that COVID-19 came and the Russia-Ukraine crisis followed almost immediately, and this affected global food prices significantly. In 2022, we saw astronomical increases in price of food items and production inputs, the highest we've seen in a long, long while. All these activities pointed to the importance of food sound and robust food securities at the country level. When you have issues such as the COVID-19 and Russia-Ukraine crisis, the first point of call for governments is to lock down their food system and ensure that there's a buffer for the citizens to enjoy over the period of the crisis or whenever the lockdown is going on. And Nigeria fell short when this happened, which caused a lot of panic and a lot of ups and downs in the country that saw inflation skyrocket significantly, and a lot of people presumed to have gone hungry due to this. But for us at AFEX, the key lessons for us, and one of the things that supported our drive as a company, are the things we took from this crisis. The first, which is being, for you to have a robust food system in any country, you need a sound and efficient logistics infrastructure. You need a trusted system for financing of production activities, and then you need a ready access to markets. All of this forms the pillar of what we believe in AFEX and what drives our everyday conversations. Over the years, we've engaged players across the ecosystem, from smallholder farmers to policymakers, manufacturing companies, financing institutions, capital markets operators, regulators, and everybody you could think across the value chain. And the aim for us is to address these pillars of food security that we mentioned earlier. At AFEX, for us, food security is not just a buzzword. It is what keeps us up at night and gives us the strength to start a new day. And the outcome of our various engagements over the years is the reason why we're having this session today. Over the next couple of minutes, we will be discussing factors that are critical to the food system of the country and the possible implication of this, from financing the impact of food security in an ever-dynamic operating environment and the possible outlook for the food security and its impact on everyday lives of citizens in Nigeria. And for me, I couldn't be happier with the set of panelists we have there, and you get to experience them firsthand over the next 60 minutes as we dialogue around this. We believe in a system that holds potential to unlock finance at AFEX, and both short-term and long-term, which we believe is critical to ensuring the food security of the country and indeed of Africa. And when you have this kind of structure in place, then you see the potential of an economy, of a sector that is a key driver of the economy, greatly increased with an impact across the lives of every aspect of the Nigerian economy. And this is one of the journeys we are proud to take part in and move on with. It is worthy to note that we still have a long way to go in getting the right solution for the food security in the country. However, we believe that starting the journey is a huge step in getting the solution. On the back of this, I would like to welcome you to join me in this our food security conversation as we look at the 2023 Annual Commodities Outlook that drives for Nigeria and the possible implications across every factor of the food system. Thank you very much, and do enjoy the conversations.
Thank you, Yinka. Thank you. That was really great, and it helped in setting the context for the session. Just so we keep it moving, we're going to be inviting David Ibidapo, our head of research at AFEX, to give us a snippet from the Annual Commodities Outlook. David, over to you.
Good morning, everyone. So let me confirm if you can hear me.
Yes, we can.
All right, thank you very much. And I want to appreciate everyone for joining today's event. So without wasting any of our time, I would like to just go ahead and present just some parts of our reports. Okay, so let me confirm you can see my screen. All right.
Yes.
All right, thank you very much. So like I said, welcome to this year's annual commodity review and outlook from AFEX. So very shortly, we'll be bringing you some of the highlights for last year and what we think our outlooks will be for this year. All right. So just to forge ahead, I would start by looking at the global commodities market last year, 2022. Now, one of the major highlights for last year was actually the supply disruption that happened as a result of the Russia-Ukraine crisis. And also we saw a number of increased demand across a number of economies, and amid some level of supply side constraints, right? And on the back of this, we saw major prices of commodities across different commodity classes increased significantly in the first half of the year, right? That was very, very significant. So if you look at the likes of energy price, if you look at agriculture, precious metal, you see that even for fertilizer, which was the biggest hit last year, fertilizer prices in just Q1 2022 rose by approximately 23%, induced by the crisis between Russia and Ukraine, right? So we also saw commodities prices, agricultural commodities prices like soybean, maize, right, also increased by 33% for soybean, rice 11%, and maize 30% just in the first half of 2022, right? For crude oil prices, yeah, we saw crude oil prices rally significantly last year, also on the back of supply disruptions in the international space, right? So just like I mentioned, some of the factors that we believe actually shaped the global commodities market last year was around the Russia-Ukraine crisis, which was like the biggest factor for us, right? Then we also saw a number of, so if you look at the graph initially, you see that in the second half of the year, we saw prices began to moderate and in some cases decline significantly for some commodities. And that was on the back of the fact that we saw some level of slower global growth, right? Demand levels began to drop. However, in some developing economies like Nigeria, right, and some other developing economies, we saw the weakening of currency, right, also still impacting on the prices of commodities, especially food prices, right? So we were not really able to see that translatory effect on these commodities prices. Then a very big factor again for us last year was the climatic shock that we saw also last year, right, in the global space, right? So many countries like Argentina experienced reduced yield, and some countries like Brazil, USA witnessed delayed farming on the back of climate change. In the local commodity space, so we understand that the agriculture, just like Akinka mentioned, the agricultural space is actually the sector is actually a very key sector in the Nigerian economy. For a sector that contributes at most that contributes up to 29% to the GDP, right? You know that sector is actually a very key sector and holds a lot of promise for the growth and development of the Nigerian economy, right? So this is just more or less like a snapshot looking at the macro economy. So average growth in GDP has averaged 2.7% since 2011. That's actually very slow. It's snail paced in my opinion, right? When compared to population growth at estimated at 2.5%, Inflation, yeah, we know that one of the biggest complaints, or one of the biggest factors last year was inflationary pressure, which actually kind of slowed a lot of things and also created more woes for the households, right? When you look at the GDP, so if you look at the agricultural GDP, you will notice that the agricultural sector has remained very resilient over the years, despite shocks in the global and also in the macroeconomic space, right? But however, we understand that there are still some challenges in the space that we need to actually fix, right? For a sector that holds a lot of promise, right? We should start looking at how to diversify Nigeria's revenue base from earnings we get from oil sector and to earnings gotten from non-oil sector, right? But the agricultural space is still largely in deficit, right? We import more than we export, right? And food inflation is still rising, and the deflationary pressure on food, on commodities prices, on food prices is still there, right? So I think our panelists will do a lot of justice to this. So if you look at factors that actually shaped 2022 domestic market in the local space, the Russian-Ukraine war was actually a big one for the Nigerian economy, right? And why was that? Because it kind of impacted on our outlook for commodities outputs for the year. And why is that? Because we saw that on the back of the Russia-Ukraine war, fertilizer prices surged significantly. And on the back of that, a lot of farmers, consumption of fertilizer in the economy reduced significantly, right? So we saw a lot of farmers actually rotate from planting commodities like maize that will require a lot of fertilizer into commodities that require low fertilizer, right? And on the back of that, we saw a decline across output levels in commodities, right? So we still also we also saw weakened naira also have impact on commodities prices last year. Then climate change was also a very big one for us in the country, right? We saw the event of flood, which kind of wiped out over 640,000 hectares of land, laying to waste the investment of a lot of farmers, right? Which also impacted on our outlook for commodities output for the output outlook for commodities like paddy rice, right? Then also we know that there are still some pending structural challenges that are yet to be resolved in the agricultural value chain. All of these, in a way, have kind of contributed to worsening Nigeria's food insecurity, right? And that's a major challenge that we think it's very important for us to discuss and find out ways to ameliorate these challenges. So if you look at the prices of commodities over the last 3 seasons, now one of the things that you'll find out is that every season commodities prices have always registered new historical highs, right? And that to me, I think to a large extent actually worsen the purchasing power of households, right? So if you look at maize, maize has increased on a year-on-year basis, on the average, by 10%, soybean by 22%, paddy by 21%, and sorghum by 20%, right? So every year, we've seen commodities prices register new highs. Increase even as we speak currently, we've seen a lot of we've seen commodities prices on a bullish run, already crossing some historical levels. And we think that may not the brakes may not be applied soon, and that could actually continue for a while. However, so like I said also, last year we ran a survey to forecast production levels across a number of commodities. And on the back of some of the challenges, some of the factors I've highlighted earlier, we saw that production this year, production in 2022 wet season was going to decline significantly across a number of commodities, right? So like maize, we forecasted a decline of 14.49%. For paddy rice, due to the impact of flood and also the fact that a lot of farmers actually shied away from wet season planting, we forecasted a 22% decline in output levels. For soybean, a lot of farmers rotated into soybean because of the low fertilizer usage in that commodity, right? So we saw a forecast of about 7% increase, but you would see that across a number of commodities, it's just a low output that we forecasted, right? And we believe that on the back of this, we are going to see some level of inflationary pressure, right, on even prices, because we have already seen supply levels low, and our demand levels in the country is still increasing on a daily basis, right? So on the back of that, we will see enough pressure on just the little available supply that we have for these commodities. Now for 2023 commodities outlook, so we believe a number of factors would actually shape the global commodities markets. And that's one, deteriorating global growth. So on the back of higher inflationary levels, and on the back of the slowdown we're already seeing in the global economy, right? We think this is a major factor that would also shape commodities prices. The outlook for commodities price in the global space is that prices would actually moderate on the back of low demand and slow growth. But we also think that there's some risk that can make this not really be the case, right? Now, we've heard news of the drying up of the reduction in the water levels of the Mississippi River, which actually forms a major and a cheaper route, right, to transport commodities, transport grains in the US, right, and into the global space, right? And this is also coupled with the fact that the Russia-Ukraine crisis is still ongoing, right, and the Black Sea region is still affected, right? So we think this is actually a major factor that would actually shape the commodities market in 2023. Then also input costs. Several businesses, particularly in Europe, have temporarily shut down manufacturing facilities as a result of rising input costs, right? And on the back of this, we think that we would see some level of supply crunch for inputs, for key inputs, especially for fertilizer, right, which would also affect production this year. And we would always see that translatory effect on countries like Nigeria, that relies heavily on importation of fertilizer products and inputs, right? So La Nina, right? According to the U.S. National Oceanic and Atmospheric Administration, in October assessment, they predicted that La Nina conditions will probably persist into early 2023, right? And which will likely cause some level of drought in the Horn of Africa and heavy rainfall and flooding in Australia and Southeast Asia. And so we think this already gives us like a level of bleak outlook for supply levels for commodities in major producing regions in the global space, right? And we've also seen a number of economies take some protective measures, like reducing exports for some of their commodities, and just in a bid to like fix to meet with local demand for these commodities. So all of these are risks that we believe are actually going to impact on price levels, price movements for a number of commodities in the global space. So for our global outlook in 2023, so like I've mentioned some of these already. So these factors we believe are going to actually drive some of these outlook, right? Tightening financial conditions, restricting monetary policies, labor market imbalances, supply demand imbalances, increased geopolitical tensions, rising energy and fertilizer prices. Then also the big one, the weather conditions, climatic shocks in the global space. Now, in the domestic economy, we also think that there are a lot of risk to price levels this year. First of all is the fact that our outlook for production levels across key staples in the domestic economy is actually very bleak. So this is like a chart showing our forecast across a number of commodities. And one thing you will notice there is that we are expecting to see the biggest decline across in output levels, in production levels, across these key commodities when you compare it with the last 3 years, production in the last 3 to 4 years, right? This will create a very, very significant supply crunch, right, for these commodities, and would in a way pressure prices for these commodities. Year to date already, we're already seeing some bullish run across commodities prices, right? Year to date, prices of grain commodities specifically have rallied by at least 12%, right? And in the short to medium term, we are seeing prices increasing by at least 15 to 16% across a number of grain commodities, right? And when we looked at some possible factors that we think could either determine the direction of prices this year, we see that a lot of these factors that we had considered would actually impact. So for example, now reduced production would cause prices to actually increase. There's a potential price increment on the back of that. International demand, you've seen high international demand for commodities like soybean, right, which will also pressure prices upwards. Reduced opening stock and the weakening of Naira. And we've been able to ascertain that there's a strong correlation between the movement in the FX market and also price of commodities, right? Energy prices, I think this is actually a very big one because sometimes last year we saw commodities prices at farm gate level reduce. However, we didn't see that translatory effect on prices of these commodities at fork level, right? And this because of higher energy prices. Diesel prices have increased more than 300 to 400% in just 1 year, right? And that's significant. And we know that would actually impact on logistics prices, which will also impact on the final prices of these commodities at the consumption level, right? So this is our forecast for the domestic market. It's gloomy, and we think there are further threats to food security in the country, right? So we also think that we could, there are possibilities to navigate the market terrain, right? So the commodities market has always proven to be a safe haven to currency devaluation, right? And also has always proven, has proven to be a good edge against inflationary pressure. And we also think that investing in the commodities space could actually also serve as a means to diversify investment portfolios. So these are just like a quick peep into what we have in our reports. The report is more detailed, explaining some of these factors and what we think would drive the trend this year. So on the back of that, I say thank you very much for listening.
Thank you so much, David. I think that went into details about what we're looking towards the 2023 outlook. I'll just be moving, or rather inviting Miriam Tobun, our Vice President, Corporate Services. She would be moderating the panel sessions. And I want to urge everyone, if you have questions, please indicate by putting them in the Q&A box just right below. And if you have any comments, you can leave them in the chat section, just so that we're able to get to your questions in the Q&A boxes. So over to you, Miriam.
Thanks, Adana. Thank you, David, for the good presentation. Good morning, everyone. My name is Miriam Tobun. I'm the Vice President for Corporate Services here at AFEX. I'll be your moderator for this panel session. Joining me on the panel session is going to be Akim Oyewale. Akim is the CEO of Marble Capital and also Addison Scholar, and he has over 20 years of experience in the investment and investments, credit marketing, trade finance, and sustainable finance field. So we brought the big gun. Welcome, Akim. Good to see you here. Also on the panelists today is Robert Omotunde, who is the Chief Investment Officer of AfriInvest. Robert Robert is coming with his 12 years of experience in investments, research, and strategy. And he's been with organizations such as Sankore, Meristem, ICO Capital, among others. Hi, Robert. Good to have you here.
Thank you. Thank you.
Thank you. So last but not the least is Dana. Dana is the CEO of AgriAC. Dana has previous experience in digitalizing the flow of commodities and market information and payments across Africa. She aims to solve problems such as problems for farmers, aggregators, and industrial processors. So Dana, I see that we have that in common. Good to have you here, Dana.
Yes, thank
Okay.
you.
Okay, let's get to it, right? The world is facing what the economists call polycrisis. As if that is not enough. Just recently, yesterday, Moody downgraded the federal government bond lower than it used to be. Layer that on the fact that Nigeria is having an election year, right? We begin to see how it is critical and important to have conversation around this. What is the attractiveness of Nigeria, the agricultural sector? What are we expecting? So, last year, Nigeria's inflation number has been on a steady rise since the past 2 years, I believe. One of the chief contributors to this has been the food inflation, which every one of us must have felt one way or the other. So speaking from your individual perspective and the work that you do in your various organizations, how do you think that we can help bridge some of this infrastructural gap that has been plaguing the agricultural sector? Dana, ladies first. Let me come to you. Hi, Dana, can you hear me?
Yes, I can hear you. Can you hear me?
Yes, now loud and clear.
Okay, so when you talk about, from my own perspective, when you talk about agricultural infrastructural gap, I think you're also referring to the reason why there's a lack of financial investment in agriculture, because we see that most of the time, financial investment and development organization funds are not directed towards agriculture because of the lack of infrastructure. So this has been plaguing the agricultural sector for so many years. According to PwC, they are saying that only less than 3.8% of bank loans and investments have come into agriculture from 2018 even till now. But then the sector has been resilient. And then the question is about how we can, how we can solve for the current agricultural gaps. It has been a long journey, and I think AFEX is doing a very good job at that. So first of all, I would say structuring the right financing, because there's a problem right now. The current policies, the current inflation rate has led to low purchasing power, even for the farmers and the aggregators and everybody in the sector. So it's almost like what I could afford many years ago, I can no longer afford, pushing so many people out of the system and then leaving just a number of people in the system to run the large agricultural space. So I would say structuring the right finance for the right process and the right timing in the sector could help us bridge some of these gaps. I mean, the sector, we don't want to lose a lot of people who have been experienced in the sector because they do not have the right financing and they are frustrated and then they leave. So it causes a lot of, it doesn't help us to reach our goals of food security and a whole lot. And then the second thing is the application of technology and data infrastructure. Again, investors will not have the right confidence to put in their money because there's no infrastructure. And the level of infrastructure that they can see, both foreign and local investors, are that they can have a lot of visibility, and that visibility gives them comfort. And then the processes are very efficient for them to see and then invest their capital. So there's a lot of push towards technology. I know that the agricultural sector is highly manual. and traditional, but being able to invent, or let's say to produce technology that is around the scenarios of the farmer and the aggregator that they can relate with and is user-friendly enough for them and also understandable by the investor, is a way to bridge that infrastructural gap. And the third point I want to mention is collaborations. Private collaborations and private-public collaborations and partnerships, because we bring in the knowledge, we bring in we bring in the expertise, and then the government helps to set policies that can favor businesses, or that can favor the sector, both considering timing. And that's one thing we bring, because we bring in the knowledge capital, right? And not only policies, but helping the security situation so people can have the rest and peace of mind to invest the capital that we produce the infrastructure that is required. I think we have to meet ourselves at a midpoint where companies like AFEX and ours and a lot of other companies can provide that comfort and confidence, have the right processes, and make the people that are not in the agricultural sector, who have the right capital to invest, help them to build the processes, the policies, and the how will I put it, the frameworks for investment in the agricultural sector. And then they have the confidence to build the right infrastructure. And then when you go to the right infrastructure, are you talking of storage infrastructure? Are you talking of input, whatever you want to do in input? Are you talking of logistics infrastructure? So the whole is a wide value chain. And I think there's much more room for collaboration and a whole lot of that. So I'll stop here. Thank you.
Thank you, Dana. Interesting point, particularly like the point on collaboration, right? It's time that we as private sector, even as the public sector, begin to pull resources together to make a change. Also fantastic points on right financing at the right time. Robert, speaking of financing, that's your field, right? From your business, what are you guys doing? What do you think we can do to put the right infrastructure to support the agricultural sector?
All right, thank you, Miriam, and thanks, Dana, for the excellent points you make. I also see you are keen. So I think the question you've asked, it's a very important one in an economy where, what I would call capital formation is not as buoyant as it should be. As you may be aware, Nigeria is still a low-income country. When you compare us to other, countries within our category. Not just that, we are not able to build enough capacity in terms of capital from within. Then what we should then be, leveraging on will be to attract capital from outside the shores of the country. If we are to optimize our potentials in terms of, what is obtainable within the agricultural space. If I leave that point for a moment, we all agree that the space of agriculture is so broad that it seems like when we talk about, the primary aspect of agriculture, we have not even fully established the potential, not to now talk about what is obtainable in the value chain, in terms of, transforming those primary products into, much more value-giving, I would say products as well, in order for us to be able to optimize the best returns, that will benefit the life of the farmers, improve your GDP and the likes. So, but we're in an unfortunate situation where attracting capital has become very difficult for us as a country. Again, because we're not doing the right things, we're not putting in place, appropriate policies, that will attract foreign direct investment, because that's what can actually benefit the agricultural space. Not so much of foreign portfolio investment, because they just come in for their own, portfolio gains. And perhaps when a commodities exchange like AFEX is fully well established, and then you have agricultural companies quoted on the exchange of AFEX, maybe FPI will become more, valuable. But for now, I think it's more foreign direct investment, that will, make the space a bit more attractive. And this was policy choices that we are making, come to play in the sense that, we are in a country, you talk about inflation. Inflation is being in the double digits, rising above 20% as we speak. You've seen monetary policy, we're trying to catch up with inflation. Unfortunately, market rates are, seriously underwhelming in terms of catching up with the level of inflation. That's when people then begin to turn to alternatives, and the alternatives here in the commodity space. But again, because of all of the challenges, the constraints that are available within the space, I'm not even sure that the safe alternative, so to speak, can offer what is maybe sufficiently convincing for investors to put their money into alternative investment. So if you understand what I mean, in an environment where inflation is 20%, a safe alternative that will pay you higher than 21, 22% is not common, if you understand what I mean. Yes. So, and to that extent, investors then begin to think maybe they would need to forego the idea about real return, and then try to look for at least relatively safer investments that will still yield higher than, the alternative, the traditional investments. So, and this is where, of course, AFEX comes in, and, you guys have been doing an excellent job in terms of, rolling out products, partnering with farmers, for which investors, our investors are looking for higher yield, that unfortunately we cannot offer them through the traditional investments. Treasury bills today is even a single digit at the highest, tenor. Bond yields are still trying to catch up with the level of MPR, and we're not sure if that can even happen before the end of the year, given, the overcrowding of that market by the debt management office. So people then have to then turn to alternative players, in order for them to be able to get that return. So what I think is that from the local perspective, the few capital that are around are looking for the best return possible. And that's why you see today that most investors are not even cautious anymore about the risk of the investment they are willing to take. It just seems like it's all about the return at this point in time. Of course, it's not the right disposition, but it's about the fact that investors think that they are losing value because of high level of inflation, exchange rates rising and all, and they just want some form of compensation as a way of compensation through their investments.
Thanks, Robert. Fantastic points, really painting out the current situation that we have on our hands as different players along the value chain. And yes, I completely align with your point around even the FDIs that would help restructure the agricultural sector is no longer available or is now very expensive, and now we need to pull local resources together. Akim, let me come to you as someone who is in the capital market space, from your company's perspective and the work that you do, how do you think, we can help solve this?
Okay. Thank you so much, and thanks to AFEX and the team here for your contribution so far. So the concern, the major question about the infrastructural challenges that are being faced in the commodity space and how we can support the resolution of it through the capital markets. I have about 4 main points. Just layering on what Dana and Robert said earlier. But the first thing for me is that investors are looking for real returns. As much as possible, with a bit of moderated risk. They want returns that are exceeding inflation so that they can be able to go to bed and know that they actually got real returns. And one of the areas can actually get that is the commodities industry, is the agri industry. However, for us to be able to fully harness that potential, we need to ensure the infrastructure is properly in place. When David was making his presentation, he emphasized the fact that the price of agri stuff at farm gate level is significantly lower than the prices at fork level. Now, what is that gap? What is that difference? The difference for that high differential is largely because of the poor infrastructural state that's plaguing our agri industry. So that's number one. Number two for me is timing. we are currently getting to seek funding for most activities in the market, on the short end. So you have tenor funds of 30 days, 180 days, 270 days. That's where a lot of agri firms actually getting the funding. That is not sustainable. That cannot build the infrastructure that's required in that sector. So we need longer dated instruments, and if we are able to, we've not been able to succeed in that. If we're able to get support from organizations like InfraCredit to provide appropriate guarantees, appropriate wraps around infrastructural funding, that are needed in the agri space, that is going to solve some of the problems that I think we are facing. The third thing I would like to speak to is the need for us to do what I would call establish a green fund, but a green fund that is managed from the private sector, that is dedicated towards specific commodities or agri-related infrastructural projects, whether in terms of storage, whether in terms of irrigation, whether in terms of logistics. We need to have that. Of course, we had instances of NISAL being set up to provide some support. We've not seen a lot of value, a lot of achievement in that. Maybe that should be revisited, but a fund that is managed from a private sector lens can actually allow us to achieve a lot more support from that infra level. Finally, I would like to think that we need the support of the regulators. The regulators should put in policies to encourage infrastructure investments, that will target the agri sector and support the agri sector. And there are many ways that the regulators can help in that, either by providing some incentives, either by ensuring that whoever invests in a particular form of infra for the agri space gets some level of relief, whether from a tax perspective, whether from any other fee payment perspective. That's going to encourage investment in this sector. I would like to stop there for now. Thank you.
Thanks, Hakeem. I think that I like the point about, having patient capital. I think that's what you were talking about when you said longer dated instruments. Patient capital dedicated to the agricultural sector, and also having green fund, which are like creating funds that are just specific to the agricultural sector. So, just looking at all the conversations so far, right? One thing that keeps jumping out is that finance is a critical thing that we need to put in place for the agricultural sector. So zooming in just on the finance now, in 2022, did we see any correlation or overlap between the Nigerian commodities market and the traditional capital market? If so, in what way did we experience this? Let me come to you, Hakeem. Hello, Hakeem, can you hear me?
Thank you very
You're
much.
mute.
No, I was muted. Yeah, I think I'm back up now. Yes. Last year, for example, there are three major segments you may want to talk about in the capital market: the fixed income market, the equities market, and of course, the commodities market. From the exchange, from the NGX, for example, the equities market, which is one of the very popular markets in the capital market, across the year last year, we had return of about 20% on the NGX All Share Index. So that was interesting, but that does not tell the whole story, because during the course of the year, we actually had a lot of periods where the market was actually in red. For example, in October last year, the market was in red by up to 11%, minus 11%, before a rally in December, that made it return the 19%, 19.9% we had. Now, if you compare that with the commodities market, one of the benchmark investments that we saw last year was the FETC investment by the AFEX Commodity Exchange, which was just for about 270 days. And that gave investors a return of 31%. That's even lower than what the return was in previous years. So you will see that commodities has literally come to stay, as an alternative, to the regular capital market investments. If you understand the timing is very key in commodities investments. Then other aspect is the fixed income investment. And I think Robert spoke a bit about it last year, about the performance. Even right now, we're having single digits treasury bills. We're having bond yields not really up to inflation, yet we are having investors actually demanding above inflation rate returns. So you can say very easily, that the commodities market, at least in the last couple of years, has provided investors that additional alpha, additional positive returns that they may get if they are able to invest at the right time. And this is irrespective of some of the challenges that David outlined in his presentation, especially the challenges with the floods, the challenges with the Ukraine-Russian war, and even the challenges with the supply of commodities. We are 200 million people in Nigeria, for example. We still want to feed, so that already gives a minimum level of demand that you're going to have for agri or commodities products in the year. So the agri commodity industry actually gives an alternative, a positive alternative to the other industries, other capital market spaces like the equities and the fixed income. Thanks.
Thank you, Akim. Robert, also in the finance space, did you experience something different, or just share with us what was the correlation that you saw?
Yeah, thank you. So I think Akim already touched on the larger part of it. So I'll just buttress that in the sense that if you played in the fixed income market last year on the local front, you're lucky if your portfolio is marked to markets, you probably made a loss, because the yields were not stable throughout the year. Of course, it's not expected to be stable, but you can't even predict, what the yields how the yields will behave, throughout last year because of, the huge borrowing of the, federal government through the debt management office. So, I mean, we saw a lot of low activity in terms of trading activities within the fixed income market. So investors that bought into bonds last year majorly or treasury bills were, typically just, buying for the yield, or they are regulatorily mandated to buy those, securities. For instance, in the market today, we have a lot of funds that are tracking the bonds market, money market funds, that are basically tracking, treasury bills. By regulation, they are supposed to buy those securities, otherwise they get fined by the SEC. So because of that, you will see some traction in those securities. But I mean, if you compare to what the equities market offered last year with all of its volatility, you would say that relatively equities market in terms of performance was better than the fixed income market, because of course, except you're, holding your portfolio to maturity, that's the only way you're able to report at some level of yield. But even at that, the equities market still outperformed the best level of yield you could have gotten in the fixed income market. Now to the ETC, luckily, we bought into the ETC note last year, and we always tease the AFEX team that, I mean, it was a very good investment for us because it returned over 30%. So in our portfolio, if we are looking at the performance based on different asset classes, we would say that commodities, provided the best. Now, the point now is, but one thing that we also discovered is that the choice of commodities in the portfolio, so in the basket, that index was also very critical. You're talking about rice, maize, soy, I think sorghum. Those were like the major commodities that made up the ETC itself, which we tracked last year. So it seems like those commodities are, permit me to say, they are not necessarily staple commodities, so to speak. Some people use them as food, but they serve as a major raw material for, poultry feeds. I think perhaps rice is the only major staple you will say you have in those commodities. Others are, input into producing other produce. So for us, we would think that, such type of commodities, especially when the market is well understood in terms of how, the outlook, and the outlook report comes very handy, looking at how the performance was last year and what the outlook will be for this year. So, but of course, the expertise is needed. And that's the gap that I think the AFEX team is filling at the moment. We are looking forward to a time when asset managers like us will step into the shoes of some of the guys creating these products, and then we can, be the one offering them, while AFEX is providing the infrastructure for warehousing those commodities, ensuring the right quality, and then we are just issuing notes on the back of those commodities that already are warehoused. I mean, a lot of knowledge, a lot of engagement with the market will still be needed, especially at the level of AFEX, because give it to you, you guys are far ahead of every other player in that space in the country today. Thank you.
Thank you, Robert. I like what I'm hearing. You guys are making me feel like I'm working for the right organization. but I mean, interesting stuff on, having the right knowledge in order to take the right position at the right time, and also the correlation that you saw. So Akim, I'll also come to you on this question, right? There's been this lingering effect on global monetary policies. We've seen, tightened monetary policy, including even our country here, Nigeria. And everybody already feels the threat of a recession. And I know you've mentioned this in your past points, right? But for a second, let's discuss, do we see the commodities space also exempted from this? Do we think that the commodities space is going to be exempted from this recession? Is it going to be impacted or otherwise?
Okay, thanks so much. I mean, yes, I mean, I think I alluded to it a bit in my last comment. Yeah. So I'll repeat myself, in Nigeria, and Nigeria is just a microcosm of what the AFEX is doing. I mean, AFEX is already outside of Nigeria. We are 200 million people. That's a huge number of people that need to be fed. In addition to feeding people, I mean, like Robert mentioned, some of the products that are being consumed or are being produced in the agri sector alone, we are not yet talking about metals, which is another aspect of commodities, are being used for other things, poultry, beverages, and the other items. So what that means is that there is already a minimum quantum of demand for agricultural produce, that has to be met. If we don't meet it locally, we'll meet it via importation, and there's been so much incentives that are being provided for local producers to actually mitigate the need for importation on most of the aspects of staples that we use. So that, to that extent, you have a bit of a comfort level that reduces the impact of any recession the country might have, at least from the agri sector. The agri sector, Akinka told us, is 26% of our GDP. At some point last year, it was actually 29% of our GDP, from the NBS. So that means that the agri sector is able to provide that cushion, that stopgap, for any challenges you may have from the threats of recession. Now, how does that impact prices and trading in the commodity space? It shows you that there is a level of trading that will continue to take place, that still gives investors that opportunity to make good returns. Incidentally, whether you can say it's not a good thing, but the reality is that most of the products in Nigeria from an agri space are still seasonal. We're yet to have that efficient irrigation infrastructure that allows us to produce most food items or agri items all through the year. That already gives us a limit to how much we can produce. And already, because of the demand that we already have, we are always going to be struggling to meet the demand in Nigeria. The AFEX, the quantum of products being traded on AFEX compared with the quantum being produced in the country from an agri perspective is still in the single digits. What that means is that there's still a huge opportunity to transfer or transmit most of the agri produce to be traded on the exchange, on the AFEX exchange. And that gives a lot of liquidity potential, for activities on the exchange. So in summary, yes, there's going to be additional threats of recession in the world, I mean, given all the factors that David explained earlier. But from an agri and from a commodities perspective, I think we already have a cushion, and that means that that sector is likely to continue to grow, and we buck the trend to a large extent from the global challenges we're going to face from a recession perspective. Thank you.
Great point. As long as there are people living, there's mouth to feed, and the sector will continue to leverage on that. Dana, let me come to you for a minute, right? We saw the impact of the flood, the devaluation of the naira, and also coupled with socio-political situations in the country, which impacted commodity prices in 2022. And this has even started flowing into the new year, which we also saw on David's presentation. As one of the key players in this sector, what are some of the effects that are likely to impact your operations, and what are you putting in place in your company to mitigate against this?
Okay, thank you. Thank you, Miriam, and thank you, AFEX again. For me, I know that flooding doesn't happen overnight. But before I say something, I have something to say about the monetary policy, just in case later on. But I'll answer this question immediately.
Okay.
So, flooding doesn't happen overnight, right? And because of what happened last year, personally for me, I became very keen about NIMET and what they had to say about weather conditions and flooding and drought. Already, they have released a statement concerning 2023, where you have early onset of rainfall, late onset of rainfall in some places. So I think data gathering for more intentional planning is a good way to prevent. I know that sometimes the accuracy of the data can be questioned, but it kind of like helps give a leap to execution, and then you understand what you're going to execute before you execute. So you kind of like have an idea of what the weather conditions or what could happen in a particular location that you are looking to invest in or you are looking to farm in. So, for instance, there's an early onset of rainfall in places in the south because they are closer to the river belt. And then if you have been in this space for a very long time, you should understand how some of these things work. So if you're going down south to farm, you don't want to go closer to the river belt, because if from an infrastructure perspective, all of the dams and all of the things that they are supposed to put in place have not been put in place. So that helps you in planning and then budgeting, and you're preemptive to how you want to invest your infrastructure. Another thing is that even if you have done a proper risk-adjusted planning, you also need to do a lot of monitoring and evaluation. And then farmers themselves have a way of preventing this thing. And then there's a place for insurance. These are the logical things to do. I mean, insurance, but then we know that the insurance sector for the agri, the insurance for the agri sector is not properly optimized to suit the agri space. Permit me for a lack of a better word, because I know that the insurance companies are working overtime to do what they have to do, but I think that it is not properly optimized, so we can't maximize the entire value in that that it brings to the agricultural sector. So from a logical perspective, and if I'm talking to an investor, I would rather say, okay, preemptive planning, risk-adjusted planning, and then insurance to be put in place. But as an entrepreneur, I wouldn't want to tie down my capital trying to make the insurance companies give me money. We all know that that whole process takes a lot of time. But what I would say is that aside from having all of these things in place, before you even go on ground, one of the first things that you need to do is to understand the kind of farmers that you are working with, if they have experience in handling such kind of negative or adverse effects, and working with people that have the credibility and have shown sufficient track record to be able to manage this type of things. And then the farmers have their own local ways of building sand bridges, practicing mixed cropping, just so that they prevent, and then using climate resilient strains, farming climate resilience strains. And then now you want to talk about the seed companies, the type of fertilizer they use, the type of land, how the landscape is structured, and a whole lot of that. So it's a whole lot of things that you have to put into consideration when you're going into farming. And one of the best things that some people do is just to avoid the wet season farming, since it comes with a lot of all of these problems. But then the huge investment in dry season farming would prevent people from investing in it, because we all know what is happening. Also tying it to the monetary policy, like I said earlier, for some individuals who want to go into the dry season farming because of his because that's proven to give you better yields, and there's less risk when it comes to climate or adverse, adverse effects. But you have to consider the high investment, because now you're talking of irrigation methods that can give you the kind of volumes that you are anticipating to have. So all of these, now that we're talking about the kind of frameworks and financial instruments not sufficiently tailored to the agri sector, the monetary policies around CBN, the liquidity retention rate, and also the MPR rates increasing will further frustrate capital investments in the agri sector. So all of these things form part of the challenges and things that we can do, as I earlier mentioned, to be better prepared for drought or any adverse climatic condition. Thank you.
You mentioned that you also wanted to contribute to that. Have you been able to do that? I got cut off for a while. Dana person again. Okay. I think we're just good to.
I'm here.
Okay.
I don't know if you can hear me now. Yes. So I tied what I had to say, considering from the question that you asked me already to what I wanted, the point I wanted to make on the monetary policy. I was about the MPR rate. Please, can you hear me?
Yes, we can.
Yes. So I tied it to the MPR rate, and also, yes, I tied it to the MPR rate and the liquidity retention rate of CBN, and a whole lot of things that are happening with our current monetary policy. And again, the current, I mean, there's a fiasco, the current fiasco for, especially, we felt it especially in Q4 2022 in some of the markets, when CBN laid out this policy to submit the old Naira notes in exchange of the new Naira notes, and we have some people buying commodities to kind of hedge against the risks of fluctuation. So and also looking at the Naira being further devalued would impact the agricultural sector a great deal, and will reduce the comfort that some people will probably have to just invest in the structure. So I tied that to the dry season farming, where you have to have a lot of investments going into that, as opposed to the wet season farming, which is highly risky, but then you have a lesser investment. But then depending on the inflation rate when we get to there. So you see, we are dealing with a whole lot of stuff that we need to put into consideration when we are planning and we're budgeting to have the right kind of yield that we can have. Thank you.
Thank you, Dana. Great point. Members of the audience, please, as we are having this fantastic conversation, please begin to drop your questions. I know you have a lot of questions for Dana and Cole and Robert and Akim. Just drop your questions and then we'll take it during the Q&A session. So Robert, let me shift the conversation to your end, right? Product diversification is one of the key hallmarks of robust investments, and I think at some point you mentioned it, where you try to just put your money into asset class that will at least give you above your cost of capital per se. So just zooming in on that, right? From your organization point of view, what have you been doing to increase participation in the commodity space?
All right, thank you very much. I think you rightly hit the nail on the head in terms of investment strategy for most of the funds and the portfolios that we manage. The truth is, when you look at the space, I mean the macroeconomic space, And I see Dana's frustration in terms of monetary policy. Is frustration to everybody, not just those who are in the agri space alone. Because again, although my own viewpoint is a bit, selfish, because, Dana is complaining that NPR is rising. And I'm saying it's not rising enough. It's like NPR needs to go further higher. Because again, we have gotten to a point as a country where monetary policy is no longer serving as a benchmark, so to speak. In other climes, throughout last year, the US Fed was raising interest rates to curb inflation. And as they were raising rates, market rates were following. In fact, some of the instruments that we also trade, that is Nigerian instruments in USD, they moved in line with all of those movements. But we have a situation where since May, the MPC started raising NPR. I think for the first 2 months after the first NPR was raised, we didn't really see any market movement. Perhaps one could argue that the reason why inflation is still this high is because NPR seems to be losing its value. So think about it. Before now, in fact, up till now, Treasury bill is still the rate that guides investors as to what the money market rate should look like. So we have a situation where, as at the last Treasury bills auction, for example, rates are closing at around 6% or so, or 4.something%, if I'm correct. And then you're seeing the market rates at that level when NPR is at 17.5%. So just imagine, look at the dislocation between what the policy rate is and what the market rate is. So clearly, NPR is losing value because market is now focusing on, okay, what does Treasury bills rate read, and what is the GMO going to close the bond yields at the next auction. So those are the factors that are now determining the market. So all of those factors will just create a situation where you now have a monetary policy environment that is not really reflective of the macroeconomic condition. And what that does is that it then makes investors completely confused. So they won't buy Treasury bills, they won't buy bonds. In fact, bonds is a risky market right now because you're not sure of where the direction will go. And you can lose as much as we lose in equities if you invest in local bonds right now. That's the truth. So the point now is diversification is more than ever before, more important for investors at this point in time. And this is a period where you will see, a lot of us money managers are struggling with keeping up with the demands of investors in terms of rates. You see investors, choke you with funds and say, oh, I have so amount for you. Can you give me 18%? I'm like, excuse me, where will I get that from? So those are the kind of things that we're facing now. But of course, it's comfortable for us to, it's possibly comfortable to get such kind of yield within the agri space. Then the question of concentration then comes in, because even if agri space, so you have a situation where your overall cost of fund is rising from between 15 to 18% levels. So even if agri can provide you some sort of, should I say, cushion in terms of cost of fund, how much can you take in agri? I mean, you won't take all your funds and just invest in agri. They should sack such fund managers, who has concentrated all funds in one particular asset class. So it then comes to the point that we need a lot of these alternatives, variants of alternative, if you like. I mean, there was a time AFEX came up with an asset-backed CP, so such that in my books, I could classify it as a commercial paper, even though it's still ultimately tied to agriculture. So those sort of ingenious creation of products is also necessary, such that I can be invested in agri up to the tune of 30–40% of my portfolio. But because it comes in different forms, right? I'm recognizing some as commercial paper, maybe I'm recognizing some as bonds, to speak to the patient capital that Akim earlier mentioned, while I'm recognizing some as commodities. I mean, all of these are possible, within that space. Perhaps it's time that fund managers like us, issuing houses need to be working with AFEX, at this point in time to create solutions that can help us solve some of this problem. I believe that if market is efficient on its own, it doesn't really matter what the Monetary Policy Authority, does. If we run an efficient market, in the event that monetary policy rate is not guiding the market can efficiently find its level and will compel monetary policy to move in line with what market rate is guiding. And I think that's the point where we're going. Thank you.
Thanks so much, Robert. I think I like the final points that you have. It's about changing from a pull to a push strategy. If I could summarize it, we the actors do this and then effect a change from the policy end. Dana, so we've been talking about so much about, the investment, infrastructure, the collaborations, creating creative instruments to help solve some of this challenge. For a second, let's zoom in on the key producers of the sector, right? Climate change is being a major threat to food security. So from your end, what is the level of awareness that you see among farmers about these climate conditions? And then what are those mitigants to this risk that you're beginning to see farmers put in place?
Thank you again. I think the level of awareness is still poor relative to the number of farmers that we have currently in the country, because when a handful, a good size of them now adopt some of these changes or are beginning to practice some of these changes, I think that we would it kind of would spread like herd immunity. Like every other person will know that farmers have started adopting these methods. And I see the work that AFEX is doing. I see the work that a few development organizations are doing, but I think we need to do much more in terms of awareness. We need to sound it like a gong. As much as we do some, whatever they use to disseminate any information in the local area, we need to adopt those methods so that they understand the risk. I think the average farmer just wants to come out and be supported to farm and then have his produce and just thank you God, thank you Allah, and he's done, so far as he has his money. So I think we need to use their local methods to inform them, keep being there. And again, this is why I will keep stressing investments. However we want to look at it, you need to, the private sector needs to be empowered to do this, whether it is from the government or from the other development organizations or from partnerships amongst them, or foreign investors and individual investors. But there has to be a drive, the same way CBN is driving the awareness on the change of the currency, even much more than that, and not only driving it, but being there with the farmers to do a few simulations for them to see the impact of climate and the impact of not imbibing some of these policies or imbibing some of these measures that have been taken. Also supporting them with frameworks that help them to see the value instantly, maybe having closed experiments with farmers, showing them gap practices and working with qualified agribusiness specialists or agronomists, and then packaging these solutions to them in bullets, in ways that they can digest and it can be diffused into their system, maybe curating initiatives around their health or pensions or insurance that are infused into their day-to-day, that just helps them to dilute it and digest it. And then probably in a matter of years, it won't be easy. So we need companies as resilient as AFEX to drive these kind of things. It won't be easy at first, but I know that when the farmers are constantly bombarded with this information, and you have like a station where they can easily interact with you in the local areas. I think they will eventually change. They will eventually change and adopt those things, coupled with monitoring and evaluation from people who are not on the ground and supporting the process. So that's what I would say concerning this.
Okay, I think thanks, Dana. Definitely, a lot still needs to be done with the farmers in order, as producers of our food. We need to make sure that they have the right resource to mitigate against the climate change, and it takes all of us here to play our part in making that happen. So as we wound down this fantastic conversation, Akim, let me come to you. Marble Capital is one of the leading market makers on the commodities spot markets on the exchange, AFEX Commodities Exchange. What has been your experience?
Wow, okay. Our experience, okay.
Your experience has been wow.
Yes, that's just it. But our experience has actually been very nice. I mean, what we could see is that there is so much opportunities. In fact, even AFEX as an organization is still scratching the surface, and it's really a challenge that we are yet to get as many participants as we should be getting to make that segment of the industry be a lot more liquid. So I will appreciate what AFEX has done so far, the kind of engagement they've had with the market, but as market makers, we actually see the fact that there is still huge demand, for commodities in the country, and there's still a gap in awareness that we can only continue to let people know, and hopefully it's going to get to a point where a lot of people will just be rushing in, so yes, our experience has been very great, and we see so much opportunities for growth in that aspect. I will ask investors, I will ask participants, I will ask those that have opportunities to bifurcate their investments, looking for alternatives, to really, really consider the commodities and the commodities exchange as a viable alternative source of investments. Yes, Robert has said it, there's still need for capacity enhancement, there's still need for education, but it's both a push and a pull. We must desire to know more, and as we strive to know more, then we'll really understand the opportunities therein. Thank you.
Great, thank you. Dana, I know AFEX has the Agri Service Program, which is aimed at connecting small and medium-sized SME to the capital market. And I know that I think you've benefited from this. What has been your experience? Just share so that the audience also know that this is available to them.
Yeah, thank you that I get the opportunity to talk about this in a platform like this. So I think because AFEX has been in the game, the way that they have structured the program, is amazing. So and then it comes at the right time, right? It comes at the right time. It comes with the right ingredients that are necessary for you to grow. It comes with the right it is the right instrument if you want to scale and grow and then assist the food security or productivity as it is. And I like the fact that there is hands-on monitoring and evaluation, and also there are performance checks, and there are reviews, and there are honest reviews just to make you understand what is going on if you do not have as much expertise in that end as well. So it's both a financing structure that comes with capacity building and a whole lot of stuff together, and which is what the agri sector needs anyway. So good job, AFEX, and thank you.
Thanks, Dana. Thanks. Good to hear about your experience. I think if there's one thing that has been jumping out throughout today's conversation is about timeliness. Everything has to be timely, and also creating innovative product that that solves the problem of different stakeholders along the value chain.
You know what, on that, Miriam, I wanted to say something before you asked, and it is about this timeliness, and the government wants to do something. You see that they always want to do something. They're coming up with initiatives, anchor borrowers, this, that. But I feel that I just want to throw something out there. Maybe Ayodeji can be part of the government, and people like us will vote him because people like us will vote him because we need somebody out there who is actually influencing these policies and who knows what to do that will help channel Nigeria towards achieving its food security potential. I just feel that the government wants to do, but then there's nobody in between helping them to actually do what they're supposed to do so that they can see the value in what they have done. So just throwing this out there in case.
Thanks, Dana. I will let Ayodeji know, and then I'll appoint myself as his campaign officer so that. Just to round up, right? Akinka, let me come to you to wrap this up, right? There's been a lot of conversation with our partners and different players along the value chain. But let's zoom in on AFEX, right? AFEX is no longer the Nigerian company, it's now become a multinational entity. What are some of the effects that we are seeing, that we foresee on extensive drought, and how do we see that impacting AFEX operations?
Thank you, Miriam, and thank you to our panelists. I don't think I could have done it better than what we've done here. And I think the varied perspective keeps emphasizing the need for us to be more proactive in the local agricultural ecosystem. For us at AFEX, one of the key driving forces and the point areas for us is being reference points for commodities across Africa, meaning our drive is towards making Africa a food secured continent, being poised to be able to feed the world in the nearest future. And to get to that point, we need to be able to export the values we've earned, we've perfected in one part of the continent to other parts. The business started in Nigeria about 6 years ago. We perfected the model of ensuring that we have a direct access to smallholder farmers to bring them to the capital market and then make them credit-worthy. Basically, one of the key solutions we provided in markets is a situation in which you could attract capital markets financing to drive agricultural productivity across the operational value chain. And we believe that it's time, we believe that this is the right time for us to be able to export this value to other parts of Africa. So recently we launched our operations in Uganda after previously opening the one we have in Kenya about a year ago. And for us, the drive is creating that reference points across key commodities producing regions, countries in the region, to ensure that, to showcase the value that the smallholder farmers and the producing communities, who account for 70% of productivity in the agricultural ecosystem, have the opportunity to be able to capture most of the value that is being created, right? One of the things we said over the course of this program is the fact that agriculture is critical to the economy. Access to finance is critical to the economy. And like Dana rightly said, it's not just access, but timely access of the required financing is what is required. Now, when you have all those matrices put together, when you have capital providers being able to structure innovative financial products that we can now put in place and direct to users of these commodities, the people that produce these commodities, and ensure that the cycle is complete in terms of cash being securitized, the securitized cash being used in production activities, and the products being invested on the back of that could easily be turned back to cash. Then you have a whole complete cycle for finance and agriculture. And when you replicate these products across Africa, then you're setting up a base wherein productivity of smallholder farmers could be greatly increased. When you increase this value, then you see more players coming into the agricultural sector. And the problem or the gap we have in agriculture right now is access to information, right? Like Dana rightly said earlier, we already have these weather systems and everything in place that are likely going to predict the impact of flood or any adverse effects on production activities. What we need to do as businesses, as stakeholders in this ecosystem, is now to be proactive. I don't expect anybody to start building dams, right? That's the job of the government. But are there other activities we could do to mitigate this, right? We need to see an increasingly important play of insurance in this ecosystem. That's one. We need to see a change from 100% focus on wet season farming, which could lead to a lot of flooding, to more diversified farming around dry season, where you could use advanced technologies like irrigation farming equipment, pumps that would ensure that you can get water to the places that require water for their activities. And like somebody rightly said, it's not rain that agriculture needs, it's water. And these things are driven by technology. And for us, it's positioning the ecosystem to be able to attract the capital to drive this. So imagine a fund, and I'm giving this out there, maybe Akeem and Robert to be able to give us a solution. Imagine a fund that comes there that could finance long-term equipment financing and is listed on an exchange that could attract capital, both local and foreign, to finance this. Because you know people that will be using this equipment, people that will be participating in these activities. And then you work with them over the period of using this equipment, structure a viable repayment plan, have a decent return for the investors, have a cost that is not cutthroat, that is not a cutthroat cost to the users of the fund, and then you have a viable system that ensures that capital could seamlessly revolve around this sector. Those are the kind of things we're looking at. How do you attract short and long-term financing into the ecosystem? And these are the kind of things that would mitigate the effects of natural disasters, flooding, and other infrastructure that we may, as individuals, may not have the capacity to build, but we can establish this kind of structures to drive productivity up, ensure that the continent does not continue lacking in terms of ability to produce. And our foray into the East African market, Kenya and Uganda, is just one step of the broader picture that we're looking at. Over the next couple of months, we should be setting up shops across Cote d'Ivoire, Ghana, in the West African region. And the idea is for us to have a holistic approach to solving the agricultural food systems across the African continent, ensuring that the adequate capital could be attracted to this ecosystem, deployed effectively, and then productivity increased to drive food security for the continent. Thank you.
Thanks, Akinka. Great point. It's obvious that AFEX, we don't like to solve easy problems. We like the very hard ones. Thank you very much. So just to round off the panel session on a very light note, right? If I were to give you 1 million naira today, how would you invest? I want to ask our panelists. I know 1 million naira is small money to you, right? But Robert, how would you be investing your 1 million in an election year? In all the crazy.
You succeeded in putting me on the spot.
Yes, that's my job as a moderator.
Okay, we quite agree that 1 million is small, right? So
speak for yourself,
because yes, because it's because when you look at the bouquet of investments that you could put your money into, it's quite small. But to be balanced, I would I'm sure that some of your participants will recognize that there is an AFEX commodities platform by the phone where you can invest in commodities. Okay, so I'm going to allocate 20% to equities, Nigerian equities, local equities. Okay, I'm going to give up to 50% to fixed income. All right, then I'll give 30% to commodities. That's how we allocate it.
Interesting. Dana, let me come to you. How would you be investing your 1 million?
Oh God, I almost said buy a new hair, but okay. So I think I'll do the other way around because I'm heavily vested in commodities. So I could do 70% in commodities because depends on the timing, right? And I'll target the right time to do that. 70% of my money will go to investments, and there's COMEX, right? So I can leverage that. And then the other 30%, I probably would could put that in a fixed income somewhere.
Okay, interesting.
Yes, that's what I'll do.
Akim, what are you going to be doing?
I mean, I will still ensure it's properly diversified. I mean, but at the moment, I will do like 50, 45, 50% in commodities and commodity instruments, do like 20% in equities and the rest in fixed income.
Interesting. Akinka, should I ask you? Okay, let's hear from you too, Akinka.
Well, I'm a market player, so I'll give my money to Akim and Robert to invest for me.
That's
Invest.
right.
Nice answer. Nice answer. I think with this, we come to the end of the panel session. It's been fantastic being your moderator, and I've had the best time. All of your points are very critical and, extremely, these are the discussions we should be having at different at different points of the agricultural value chain. Thank you for being a part of this, and then we'll open to Q&A and just answer some questions. Adana, do we have some questions here?
I think we have a lot of questions that we need to go through,
Yeah.
right? We'll be trying to answer some of them in the comment
Yeah,
section.
I think Miriam has also distributed some of the questions across to the panelists. So we would just keep answering as much as we can. But please, if you do have more questions, do send us an email and we would definitely get to answer all of them. The presentation slides as well will be sent across with the recording. So you have access to the meeting. The report is also live. And so you can go on our website and download and read the full report. We've also exceeded our time as well. So I'll be passing on to our Vice President, Financial Markets, Oluwafunto, to help us round up.
Thanks, Adana. Thank you, panelists. Funto, over to you.
Thank you. Thank you very much. It's been an interesting morning so far. I've been keeping so before I even go take the bye-bye speech, if you give me the 1 million, I'm not like Akinka that will give somebody his money to invest. I will do 70%, maybe 95% in equity. And in commodities rather, I'll do 95% in commodities, but I'm going to spread it across the various products that are both fixed income inclined and variable income inclined on the platform. Because AFEX has trade finance notes that would give you dollar coupon over a period of time. AFEX, you do FETC, that is also behaving like an hybrid of fixed income and variable income, because the baseline, there's a baseline guarantee on the return, but the upside can be unlimited. And of course, I will then do the spot market that then completely gives me the flexibility of having an upside that is limited, that is unlimited. So for me, it's going to be about 30% in the fixed income product of AFEX, 45% in the variable income of AFEX, and 5% in my pockets to spend. So again, thank you very much. And for me, the way I want to summarize the entire conversation is that everybody has a part to play in helping to ensure that we solve the food security problem in Nigeria. From policy to advocacy to market participation, every one of us has a role to play. There was a question someone mentioned about how are we engaging SEC as being the regulator in our market. We're actively working with SEC to develop structure that would help unlock the required capital to finance the entire value chain. The deficits in the agri value chain is in the trillions of naira. As much as we have lots of problems that that sector has, the flip side is it also presents lots of opportunities for investors, opportunity for job creation, opportunity for a growth in the economy. Imagine a sector that is currently receiving less than 10% of the budget and is returning over 25% of GDP. Imagine if that less than 10% goes to about 15%. Imagine also that of the 14 trillion naira that the PFAs are sitting on, just a 5 to 10% of that value comes in through structured instruments into the commodity space. Imagine what a whole world of difference all of those cash inflow will do. But again, it is not about the cash just coming in, but a structure that ensures transparency, a structure that ensures optimization of those cash, and a structure that ensures that investors' money will come back to them as at when due. And that is the core for us at AFEX. How do we securitize the entire process? Whether it is asset-backed or it is not asset-backed. How do we create a structure that ensures transparency, market price discovery, and trust of the market? It's going to be an interesting year. We're super geared for what is coming, and we invite everybody to join us in this wonderful train. Thank you to all our panelists. Thank you to Roberts, AfroInvest. Half of the panelists are like personal person. So I have a lot of history going on with a lot of them. So again, thank you on behalf of the management of AFEX. Thank you very much for all your support, for all your contribution, for believing in the brand, because it is not easy to stick out your brand on another brand that is in an highly perceived risk sector. So we say a big thank you to all the brands that have stuck out their names with the AFEX brand, and we do believe that we're just starting, and there's so much to get done. So welcome everybody on board. If you've not downloaded COMEX, get to download it now. Get to speak to your broker. Get the necessary advisory on how to best optimize food inflation, so that as you are paying for food inflation on one side, return on investment is coming in on the other side. So at the minimum, you are zeroized. You are not on the negative. So talk to your brokers, talk to your fund managers, download the COMEX app, reach out to the call centers. They will guide you on how to take hold of the opportunities that we are currently offering at AFEX. Thank you very much, everyone, and enjoy the rest of your day. Have a fantastic rest of the week as well. Bye.
Thank you, Funta. Thank you, everyone. Enjoy your day.
Thank you.
Thank you.